Let's Talk Real Estate Investing. In this podcast, I bring you insights, experiences, and lessons from real estate investing professionals at all stages of their journey, along with industry experts who provide essential services to you to help you to succeed. Our goal is to empower you with the knowledge and strategies needed to build a personalized real estate investing plan that aligns with your unique goals. If you enjoyed this episode, please hit that like button and subscribe to my channel. It helps me to continue to share valuable content with you. My name is Debbie Balfour, and I'm a real estate investing professional and a real estate investing success coach. Real estate investing isn't a one-size-fits-all. Your strategy should be unique as you are. Today, I'm joined by Ray Vozza. Ray is a real estate investor, multifamily owner, and a mortgage agent based in Port Hope, Ontario. He's built his own income-generating portfolio, and now he helps other investors finance and scale theirs. Ray is also a devoted husband, father, and someone who believes deeply in creating property opportunities for all. In this episode, we're going to dive into the OFSI proposed 2026 changes, and we'll explain what that means and what they mean for investors who can use their rental income to qualify for properties. Big shifts are coming. We want to help you to be aware of them, understand how to navigate them. Ray's going to break it down for you, and we're going to talk all about this ahead in this podcast today. So let's get into it. First of all, I'd like Ray to introduce himself a little bit more and tell us a bit about his journey in real estate investing. Over to you, Ray.
Okay, thanks so much, Debbie. It's so nice to see you, and thank you for the opportunity to be on with you today. I'm coming here from Port Hope, Ontario, so just an hour east of the GTA is where I'm located. As a mortgage agent, I am licensed to be able to really do deals right across the country, which is great. I'm with Dominion Lending Center, and we're one of the largest lenders outside of the top 5 banks. So I can work right across the country, which is fantastic. And I've traveled lots of Canada, so I know a lot of the country, that's for sure. And I'm excited to be able to talk about this topic today because I find that it's a little bit flying under the radar at this point in time. And as real estate investors, there's always going to be different challenges that come with it. I mean, that's just part of being an entrepreneur. There's no doubt about it. But I do find that this has been a conversation that has been a little bit on the quiet side, mainly because it's kind of lenders that are making changes overall. And, borrowers need to kind of be aware. I'm looking forward to be able to dive into this with you today. That's for sure.
I'm excited to hear about it. Kind of nervous to hear about it on behalf of other investors, but it is important for us to share this. So I'm so happy to have you here to talk about it. Tell us a bit about your journey in real estate investing, Ray, so people understand that you're not just a mortgage agent, that you know what they're feeling, how they're feeling. You've been there and done it.
So I would go back, it's in 6+ years now that I've really been a quote unquote real estate investor, right? And I've almost redefined that terms in some ways. So now I just say I'm a property owner. It makes it a lot simpler for people to kind of understand what that is all about. But for myself and my wife, it kind of goes back to say 6.5 years ago. But then when I use this reference, I'm like, hold on a second. My daughter's 10, and it wasn't that far into the journey where we really kind of started to get serious about it. So going back to, we've had our first child, and now all of a sudden we're probably 6 months down the road kind of thinking of being new parents. And, we finally got our head screwed back on, and we were sleeping, and we started to take a look at numbers, and it was like, holy smokes, like diapers. We weren't able to get any kind of daycare options because it was too busy in the Toronto area. So we had a nanny that was coming in, and Joe was getting ready to be able to return to work. And it was almost another mortgage payment was coming out of the house on a monthly basis. And it really started to beg this question of how can we go ahead and generate more income? Like, what can we do as full-time employees that can go ahead and start to be able to offset some of these costs, knowing that it's not going to last forever. Like, you don't stay in that stage forever, but it was really that step of like, what do we do? And my wife and I had owned a condo, and it was a rental property, and it had done well. We had sold it, but then the question of what do we do now kind of thing. And it brought us back to real estate investing. So it was a very, very simple start. And the goal was, can we go ahead and augment the household with X amount of dollars in terms of passive income that we don't have to go out? I mean, we couldn't go get second jobs because we were brand new parents and there was too much time on our demands. So it was a very, very simple and I would say humble reason as to why we started to become real estate investors. Throughout that experience, right, we really learned a lot, right? We had our first property. It was a great little duplex. It was cash flowing. Everything went really well. And then we wanted to be able to grow and expand. And I think this is some of the things that a lot of real estate investors have this similar experience where they start off, they've got one property, two property, maybe even three property, and then it's how do I continue to grow? And in the residential space, you hit a bit of a brick wall, right? Where the lenders are going to say you kind of maxed out at a certain point in time. That's where we got into multifamily and we started to learn the differences between residential and commercial financing. And then we just kind of kept going and growing. Ultimately, I made a decision to be able to do it on a full-time basis. And it was really last year where I completed a couple of properties in terms of refinances, got them into the MLI Select program. And after almost 6 years of renovating properties and doing all this stuff, being in construction and all of it, I just said, I'm kind of sick of all the drywall and the dust and everything that goes along with the projects. But I wanted to remain relevant. I wanted to remain in real estate. And the question was, is that where does that fit for me? And I had a great conversation with my broker and we started to talk about kind of what is the role of a mortgage agent? How do they go ahead and service the client? And it really kind of appealed to me. For me, that was kind of the turning point as to saying, okay, great, I've built my portfolio. It's doing what it's supposed to be doing. I'm happy enough with it at this point in time. And it's not like it all was always just like, yes, 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 yes. There were some yeses and there were some downs and there's some ups in terms of that span of that 6+ years. But ultimately it brought me to the place where I said to Joe, I'm going to go get my mortgage agent's license and I want to be able to build this business next. It feels a lot to me like an evolution because we did so many different types of mortgages over the past number of years. We've done residentials, we've done construction financing, we've done bridge loans, we've done privates, we've done commercial multifamily. Like it just seemed that I felt I've done so many different types of mortgages over the past numbers of years. This feels like a really common space. As the borrower, it was definitely a very common space. Now, as the agent, it's been a great year of learning and growing and kind of developing a lot of that knowledge base. And it's a really cool space to be in, that's for sure.
So what would you say the biggest changes were for you going from REI, full-time REI, to now being a mortgage agent?
The discipline is definitely the same. And in terms of, you're still working for yourself at the end of the day. It is a position where you have to build that business and you have to be able to put that time and the effort in. And one of the things that really rang true for me this year in terms of similarities instead of differences was just anytime you're building a business or those first few years, there's so much push that you need to put into it. It's to be able to get that momentum and kind of get that inertia is probably the big thing that I noticed the similarities. And the difference is, I would say, is very much in my focus now. Before, my focus was on finding great property opportunities and being able to acquire those properties and being able to execute the strategy, whatever that may have been at the time that I thought that was the best. Now it's really going back into a professional services role where it's me listening to my clients, understanding what their goals are. So it kind of takes the pressure off of some areas in terms of, great, this is my property now. And you're kind of feeling, I don't want to say the weight of the world, but it's a big responsibility every time you take a
Definitely.
property on and you want to see it do well. Now I can take all of that knowledge and be able to help investors where it's, hey, great, we want to acquire this property. Here's what we're looking at. I can be part of that conversation in terms of that vetting process, which is, here's what you want to do. This is what the property is going to really permit you to do. But here's the big obstacles that you're going to face. And you need to kind of think about that because I didn't have a lot of that in my process. It was like, hey, great, you found a property, we can get you financing and you're good to go kind of thing. And it's like, check, okay, cool. But usually you're talking to like a coach and then you're talking to kind of a mortgage person and then you're talking to maybe it's your lawyer next or you're talking to your accountant and it's different kind of parties. I'm able to kind of merge that space between like, as I am an investor and a property owner and specifically in multifamily, it's where I focus my time and my energy. I can really take a look at a property and say, are you going to be able to achieve what you want to be able to get out of this thing? Yes, no, maybe so. And if it's just not going to work, then I can be honest with the client and saying, I know you've been hunting and it's a hard search and it's a hard find, but this isn't the right one. You need to move on to another property. And here's the things that you want to be able to take a look for. So it's offering those years of kind of experience as I'm trying to support and assist and help them reach their goals.
I think that's wonderful, Ray, because a lot of times the mortgage agent, it's not that they treat you like you're just a number, but they don't have the experience to be able to help you in that way because lots of them don't even invest themselves. I love that you have this experience where you can say, did you think about this? Did you think about that? Things that mortgage agents normally don't have that experience, but you've been there and say, you need contingency for this. What if this happens? And really that risk mitigation part of things that you're able to bring up to your clients because you've been there.
You've nailed it right on the like the nail on the head there, Debbie. Like it's a really beneficial space, and it's a careful balance of you want to deliver on what the objective is. Like, great, you've got this property under contract, you want to now be able to go ahead and get the financing. I totally get that, 100%. But even in the searching process, and that's where I worked with one husband and wife team, and it took about 3 months, and we're going out to look at this property. What do you think of this? Great. That's the time where we can really get the vetting process going on to be able to highlight some of those items, which is like when you're going through your walkthrough, make sure you're looking for this, this, and this. It's not just mortgage experience. It's all the experience of walking the properties, understanding what you're looking for. Even getting a building condition assessment on it, that's going to cost you money out of your pocket. Like, what are the big red flags you need to be able to see before you even start to be able to think about putting the offer in and really evaluating it, time on the market, where it's located, what it's currently producing. So yeah, for me, that's kind of like, it really lights my fire when I can do those things, because it's the fun of like underwriting all the properties and really seeing the opportunities, which I love. I love opportunities and I love finding deals, but now it's about guiding a little bit and being able to say, here's what's really going to work well. If you want to do a BRRRR strategy, this is a winner. If it's a buy and hold, this is going to work out well, but let's not get confused between the two, because one, you want to get capital back. The other, you're going to keep it in there for a period of time, probably at least 5 years before you decide to be able to access any of that capital. But what I can say is I'm going to lean on my experience and my insights in terms of what has worked well. I don't think anyone hits it 100% of the time, all the time. You're going to have some learning lessons along the way, but I can definitely identify some of those flags in terms of like, here's what you need to be asking and here's what you need to be finding out when you're going through that walkthrough. And then as we kind of get deeper and deeper.
Well, due diligence is costly. It's great when you're able to close on that, but if you're doing due diligence and then you find out that this isn't the right property for you, you're walking away and you've put some money in. So that walkthrough, identifying things early, understanding what can you do before the cost even comes in, where you're getting the appraisals and all the other due diligence, especially for multifamily that's needed there. Definitely being able to give some insight on what they can do themselves.
Saves thousands and thousands of dollars, right? Just a building condition assessment can be $2,500, $3,000, and environmental comes in as well. Before you know it, before you've even like gotten to the point of getting your financing, you could be $5,000, $6,000 deep into a property that you think looks good on paper, but now you've like spent that money. And if you do that 3 or 4 times, well, great. There's like, 15, 20 grand that's been spent doing your diligence. No one wants to get into that position. No one wants to be that deep in the hole when they're trying to be able to acquire a property. It doesn't make sense.
Yeah, definitely. I've experienced it from a bigger perspective, land development deal where the price looked amazing and what we could do with it sounded really great. And then $67,000 later in due diligence, we had to walk away because it wasn't viable. Environmentals came back and things. So
That's the big number.
yes, yes.
That's
But
a big number.
I told myself it saved me millions. So
There's no doubt about it. I mean, it's always money well spent being
yeah,
able to execute your conditions, but at the same time, like, if you'd known now what you knew then, would you have moved forward with that one? You probably would
no,
have
and I
that
would have
67 still sitting in the bank or something.
exactly. I would have done the order a bit differently too, to know
Yeah.
that let's do this first, and then then we could do the next one instead of doing it all at the same time. Right. So yeah. So from what you're offering, I think it's great. It's great to be able to, what can you do for your own due diligence before you start bringing in the professionals to make sure that it is something that's viable. So that's wonderful. Now let's get into our topic today, Ray. First of all, we said OFSI. What does OFSI mean?
So OFSI, right, is the Office of the Superintendent Financial Institution. And this is kind of the body that oversees lenders here in Canada. So it is a body that regulates, provides different rules around what lenders are able to do. The lenders then take those guidelines and those regulations, and then they set their lending policies, really against them. When you're talking about this is not just an Ontario-based, kind of situation. This is going to go right across the country. So that's what OFSI is.
So there's some big changes coming up in 2026. Can you summarize, just highlight, and then we're going to go into deeper what those changes are?
Yeah, I think that there's, four major things that need to be happening, right? So, OFSI is looking at a number of things, which is tightening, right? We're really just talking about this, which is tightening the scrutiny from lenders on borrowers when they're looking to be able to buy secondary property. So if they're looking to buy that income property, 2, 3, 4, all those sorts of things. And let me just underscore that this isn't really going to impact the residential market, right? On the commercial side and the multifamily side, the way that the deals are structured is just different, right? On the residential side, it's really about the borrower itself. So, Mr. and Mrs. John Q, they're going to show up to the bank, or they're going to work with a broker, and they're going to submit all their financials. And essentially what the lender wants to be able to see is, in the event of, right, something happens, can they cover that payment on a monthly basis? When you're talking about the multifamily space, the difference there is they're looking at the asset, right? Does the asset cover that loan on a monthly basis? And is there cash flow remaining? Then they're going to say, let's take a look at the borrower, let's take a look at the credit, let's take a look at different aspects that they've got to be able to offer there. So in terms of the changes that we're really looking at here, we're looking at kind of four key areas. The first one would be, capital adequacy rules. Right. So this really talks about, how much the capital the banks are going to hold against an investor's mortgages. So oftentimes we're looking for loan to values that are 85%. Well, that might start to shrink down, right? They might say, no, I'm sorry, we're not going to offer you a 20% down payment. It's now going to be 25, 30, 35% down. So that means that now the borrower is at less risk because they've not leveraged themselves. The second one is going to be income producing, property treatments themselves. So stricter guidelines on how these are actually going to be addressed and documented for the qualification purposes. So instead of just rent rolls, they might go deeper than just, providing me, okay, you've got a duplex. What is the top floor getting? What is the bottom floor getting? They're going to ask for more details on those items. The big one that I think is really important in terms of the residential space is the loan to income framework. So this is what I was talking about on those ratios, where you're going to walk in and you're going to say, okay, great. As a couple or as a partnership, we make combined X. Here's some of the debts that we have. Great. We can now qualify for this. They're going to take a look at that framework and they're going to start to shrink it down so that you're not able to just say, well, we've got, typically the rule is kind of for every $100,000 of income, you're going to qualify for 4 times that on a mortgage. So if you're making $100,000, you're going to qualify for about a $400,000 mortgage. 2 people, if you're making, $200,000, now you're at $800,000. They're going to start to shrink that down a little bit, and they're really going to be, much more granular. And the last one is that it's highly leveraged borrower focus. So if you're the kind of borrower where has, done a number of deals and they're not yet in that normalized state, right? Maybe it's a BRRRR project, maybe it's a flip project. They're going to look at that with a lot more scrutiny. So it's going to make things a little more challenging. And those are the big 4 things that are coming up on the horizon for the 2026 changes.
I know you have a deck, Ray. Did you want to share that now?
Yeah. Let me see if I can get it all right here, Debbie, because I just want to make sure that I can get it right here. And let me see what we've got. Okay, you tell me if this is coming up on the screen.
Okay. Yep. I'm seeing the capital adequacy slide.
Okay, fantastic. So that's exactly it, and it's coming up on full screen. I've done 2 splits here so that I can see you and I can see this.
Yeah,
so it's coming up okay.
we have we've got a good view of it.
Okay, fantastic then. So this is the first thing that I was really referring to right here, which is, your capital adequacy, which is, it's going to directly impact investors. So what does this mean, right? It means, capital adequacy. How much do you have? How much are you going to put down? And how much are they going to want you to put down? What typically right now, if you're buying anything that's beyond your first primary residence, you're putting down 20% on that particular property. Again, they're not looking at a debt coverage ratio. They're saying, okay, you're going to put 20% down on that property. Fantastic. It's a $500,000 home. You're going to put $100,000 down. And now it's going to be a duplex property and it's going to do X, Y, and Z. Is it cash flowing? That's not really their concern overall, right? Because that's why they're looking at you as the borrower saying that, well, your income supports this, your debts are low. And, in the event of every single month, if a tenant is there, if a tenant is not there, you're going to be able to cover the mortgage payment. The big changes that we're looking at for the 2026 are higher capital requirements. Banks are going to allocate more reserves per investor loan, meaning that they're going to offer a lower loan to value, right? They're not going to always go to 80% that you're hoping for. They might come in and take a look at it and say, well, we're willing to do 65% loan to value. So instead of on that $500,000 home putting down 100 grand, you're now having to come up with an additional 15%. And that might change the ability for that investor to be able to move forward on that property. This is also going to change risk here. So as the lenders start to offer a lower loan to value, their risk is lower. They're not putting out as much money in terms of the marketplace, the overall real estate, that 80%. Yes, you put up your 20, but now they're saying, great, we're going to put up 65, you're going to put up 35, meaning that they've diminished their risk overall. They're still in a safe space. And the last one will be kind of the variable appetite. So lenders they're going to look at their preferences much differently in terms of where they want them to be able to sit, right? It's not concrete, but they might be saying, on an income property, we're not going to offer a variable rate. We're going to offer a fixed rate, right? Because for them, it's about lowering that risk overall. And that's really what we're talking about here when we're talking about these changes that are going to be taking place.
So, right. So, just for me to summarize now for that one, it's looking to me that what you're saying is that we cannot now assume. Before, we used to say we have a good idea. We made projections based on 20% down. We made projections on. We knew that we didn't have to give the bank everything in our kitchens, including our kitchen sink, when we wanted to present, what our portfolio looked like. But now the bank is looking for more in respect of that for that. So, all your registered funds, all your stocks, everything that you have, all your assets, that capital that you have, you're looking for higher ones. And now we cannot assume. So maybe we need to be, when we're looking at a property, we need to be looking at it as a very conservative view first, maybe at now 35% down, and then fall back. If we can get to 20% down, then that's bonus.
So I think being conservative is always the best approach. And then it's definitely been a lesson I've learned, right? Where you've gone in aggressively on a deal and you're like, if I can pull this off at this, and then the landscape shifts and things change, and now you're not in that same kind of scenario. So being conservative as an investor, I think, is key, right? This last market cycle has really shown us, I think, all of us a lot in terms of conservatism, about the long-term thinking strategy. Yes, some deals could be made where maybe you're doing a flip or you're doing an assignment and it's what they call the quick money or the fast money. But the real growth of real estate, as we know, this happens over a period of time. This is not just a 2 or 3 year cycle. You want to be in it for 10 years, 15 years, really watch that asset grow and the pay down mechanics happen as well. So 100% you're right, Debbie. And this is where I get to do a little bit of a shameless plug here, which is I never went to the banks directly. I never went to the banks and then said to them like, hey, I'm looking for a property. I worked with a broker for 2 reasons, really. First off, I found it a little bit, I don't know, uncomfortable going to the bank. And if they were to say no, I would feel like, oh man, maybe this is a sign. Maybe I should move forward with it, kind of things. Just for that kind of fragility, I didn't want to hear no. I didn't want to hear the bank say, sorry, we're not going to approve you for a loan. And then you kind of walk out of there and you feel a little deflated, right? And then you kind of get your gumption back up. You're like, I'm going to the bank across the street and talking to them. I always worked with an agent or a broker because they've got the ability to be able to contact so many more lenders than I do. And it's the ability to leverage that time and that experience. So they know what they're doing and they do it really, really well. And Now, I would encourage more investors to be able to start that process with it. Obviously, it doesn't have to be me. It can be anyone that you're comfortable working with out there. But start that process now so that you can have those conversations around here's the type of property I'm looking for. Here's the type of numbers that I'm looking for. What can I qualify for and what will I need to put down so that it's not something that comes up late in the process where it's like, oh, great, we've proved you at 65% loan to value instead of 80. And now there's a gap of 15% that you may or may not be able to cover and putting you in a position where you want to scramble. Get ahead of it now, have the conversations, and start to be able to find out because the broker is going to be able to have the conversations with those lenders. And they're going to have multiple conversations and saying, here's what my client's looking for. How can we make this deal work? How can we package this up? And the lenders still want to do business. So although the guidelines are tightening, lenders still want to do good quality business because that's how they make money.
And what I liked is that um, the that the mortgage broker is able to create a story around you, which you going into the banks, you're not capable of doing because they know what each lender is looking for and they can create that story.
100%. 100%. And that's really every time I'm having a conversation with the lender, the question is you give them some of the details, the numbers, top line details. Here's what we're looking for. Here's what the clients are all about. Okay, what's the story? What's the story? Tell me what the deal is. Like
Yeah.
fill in the rest of the picture. And that's part of any decent agent and broker's role is to be able to create that whole experience. It's like, it's that resume where you're working with an individual and it's like, great, they've got experience in this. They know what they're doing here. They've been able to accomplish this in the past. Like these are the indicators that are going to be able to help that lender feel that, hey, this is the right fit for us. And we want to be able to work with this particular borrower. So creating the story is really, really huge.
I know for my property's perspective, when I was getting my mortgages, uh, there was a time when we were able to say to the bank, "Oh, we're going to use the line of credit as the down payment," and then that changed, and they didn't want to hear that. But I was still using my line of credit as my down payment because my mortgage agent presented my registered funds and said, actually, she's going to be cashing these in as the down payment. But I never
Mhm.
did.
I mean, it really is, right? It's a dual-sided role, right? Where we have to be as responsible to my clients as I do to the lender, because I have
Mhm.
a duty to both of them, right? To be able to be really transparent. But when you have, like, let's say those registered funds, maybe that's going to be your choice of your down payment option, versus that HELOC. And the bank might not want to hear about the HELOC, but another lender may be very happy to hear about that, as long as it doesn't mess up the ratios too much, where it pushes up your gross debt or your total debt, where it's like now they become really high ratio. So where the bank may not want to hear about that, right? That's where the broker can really start to be able to kind of create that story and that narrative that's going to make sense for each one of them.
Yeah, they've got this, they've got that. This is what they're going to do. This is how they're going to do it. So
Yep.
awesome. Let's get back on track. So we're seeing on the screen rental income and underwriting standards.
Yeah, the big points really right here are it's going to get more and more scrutinized in terms of the underwriting. And I know a lot of it was simple kind of one sheet, kind of Excels that we were using. Here's my expenses, here's my incomes, here's the way that it works kind of thing. They're going to be looking at conservative rental income assumptions, so often using 50 to 80% of the gross rent incomes. And some lenders right now will apply up to 100% of those rents and to be able to help that with the qualification. So what does this mean? This means that, again, you, your partner, or you yourself, you're applying and you're like, great, here's my ratios. They're going to take a look at that and saying, okay, instead of taking 100% of those rents and applying it towards the affordability of that property, they're now going to start to be able to cut that back to it might be 80%, it might be 50%. So when you're thinking about this, you need to be able to look at that and say, okay, if I'm collecting, let's say it's $3,000 on a duplex, 1,500 up, 1,500 down, they're only going to take $1,500 a month. That's what they're going to apply to the quote unquote affordability of this loan. The next one is a really big one, which is no double counting of incomes across multiple applications. So you can't say on application one, I've got $100,000 income. Application two, I've got $100,000 income. Application three, I've got $100,000 income. That's going to be consistent. Your income is now your income, which is like, I've got $100,000. We carry this mortgage against our primary residence and now this against our rental property. Well, guess what? When you go to reapply, you can't just be able to put down, every time like it's a fresh, brand new, I've got $100,000 income. They're going to start to take a look at this and saying, well, hold on a second. You now got three properties plus your primary residence on $100,000 income, like you're basically at that maxed out point. So that's a really big one to be able to be aware of. And the last one is, as you're looking at it, and this goes to the conversation we had about the diligence process when you're inquiring about a property, it's the documentation required. So they're going to get even more stringent with regards to leases, rent rolls, taxes, insurance on the property, any kind of repairs and maintenance that are needed. That they're going to get very, very granular on this because lenders don't want to be able to get into a property where it's just not going to make sense anymore. Maybe there's, brand new roof that needs to be able to do. Maybe there's a plumbing issue. Maybe there's a foundation issue. So the documentations, when as a real estate investor, when you're approaching a property, it's got to be one of the first things. You're like, is it all organized? Is it straightforward? Are they current? Are they up to date? If the lease is 2 years old and maybe, someone else has moved into the space and you don't have them on paper, it's not going to fly anymore. It's not just good enough to be able to get a tenant acknowledgement form and saying, oh yeah, they live here and, they're paying me this every single month. You're going to have to be able to have much more detailed paperwork.
So for me, I know that my mortgage agent always told me that they would take 50% of my rental income. I didn't hearing about these rules right now. That's still in my mindset, so I would know that. But the big one is what you just said, is the double counting of the income, because I know that they always looked at it from a fresh perspective. What happens if you're a guarantor on a rental property that's under a corp?
If you're a guarantor under the corp, so I mean, anytime you open up the corp, it's like a brand new entity overall, and you're going to have to be the guarantor because the corp doesn't have enough financial legs to be able to go ahead and do that. As the guarantor of that corp, it's going to be when you're saying what happens in terms of what
Are they going
happens.
to look at that now when we are looking at income from a, are they going to look at that as, oh, that's already been allocated to, these properties also under the corp, not just on the personal?
Potentially, yes, they really, really are. So if you're an individual where you're just starting out and maybe you have bought your first property under your personal name, but now you want to be able to add properties 2, 3, 4, 5, whatever the number might be, but you're saying, I'm going to start to put it under a corp instead of under my personal name. It's at the end of the day, it's all coming down to you because you are the guarantor, right? So unless that corp is producing a massive amount of income, and as we know, right, it's going to produce what each property in it has. So as you drop a next property into the corp, drop a property into the corp, yes, your number is going to your bottom line is going to increase, assuming that all these properties are going to be in a cash flow positive position, but it's not enough to be able to jump it up. It's not going to oh, next property came in. Oh, there's another $100,000 in income. That's just rolling through the books kind of things. What's going to happen? They're going to continue to be as stringent on that if it's under your own personal name or if it's held on corp.
Okay. Yeah. So that's key. No more hiding under the corp.
Yeah. Unfortunately not, right? It just doesn't come that way. So, and I'd say right here, I've called this one the big watch item, but this goes to, what we've been speaking to here, which is the loan to income. So OFSI they're actively evaluating the introduction of loan to income limits, as a potential replacement or a complement to the existing mortgage stress test. So as we all are aware, right, when you're applying for a mortgage, or maybe you're not aware, right, I'm not going to assume anything, but when you're applying for a mortgage, right, we always have a stress test on it. So let's say the rate that you get approved for is, mid fours. Let's just say that. Let's say 4.25 kind of thing. You have to apply the stress test, which means an extra 2% on top of that. So really what you're doing is you're really being qualified at 6.25 instead of 4.25. 4.25 is what you'll end up actually paying in terms of the rate that you agree upon, either variable or fixed. And as we know, variable may go up and down, fixed will stay the same. But in terms of that stress test, right, they're looking at different things to be able to make sure that stress test is going to hold water. So current environment, right? Stress test really focuses on the payment affordability at higher rates. So if your mortgage went up, so let's say you were in that variable rate mortgage and they do start to be able to come back up. Are you going to be able to afford that? Not so much can the property afford that. Let's say, again, that $3,000 duplex where you're cash flowing $1,000 a month. Well, if the mortgage payment went up by another $200, they're not concerned about the property. It's you as the borrower. Can you go ahead and carry that additional payment that's going to happen? And then in terms of the framework, so here's what they're proposing, right? They're talking about total mortgage debt capped at about a 4.5 gross annual income. So as we talked about, right, typically it's that general rule of thumb, which is if you're earning $100,000, it's a 4 times multiplier. Well, if they're going to cap that between your primary residence, your secondary, that income property, right? That third income property or that second income, but that third property that you have, you really now only have, let's say, $400,000 or $450,000 borrowing power. So are you buying in a market that still makes sense? Do you need to look at potentially more affordable markets, right? Maybe you were buying in the large metropolitan areas and it was working, but now maybe you need to go out to the tertiary markets. Maybe you now need to look at price points that are lower so that you can get more of them in to be able to meet that overall. Does that make sense, Debbie?
Yep, definitely. Like you were saying, you're just using the 100,000 as an example. Before they would look at it individually and say, you've got 100,000. Now you can afford for this property, you can afford, we'll give you, 500,000. Now you have to look at that 500,000, not just on not from a one property perspective, but over the number of properties that you have, which puts that cap on it.
Essentially, yeah, you nailed it. I think you said it better than I could have. I mean, tell me how you want to answer the next one here. The last one, I think it's probably really it goes towards the overall strategy. So this one is about leverage, right? Portfolio growth impact. So what are we talking about here? So there is this mindset, with investors, and it's almost like boom or bust in some ways. And I think this is going to change that mindset in terms of like, great, it's now a buyer's market out there. We need to be able to go out because sellers are kind of, their backs are against the wall. They have to take less than the offer prices. This is the time to go get it, right? Maybe the rates have dropped. There is that kind of lemming style mentality where it's like, it's prime now. Got to go out and pick up as many properties in this year as you can. Let's slow it down. That's really what they're trying to do right here. They're saying you can't be over leveraged and you can't be highly leveraged. So they're not going to take those risks anymore of like, great, I acquired 3 or 4 properties in this given year because, the market was down, rates were down, and I was able to go out and be able to get great deals. Where investors really need to start to think about is the strategy of what is the one good acquisition I'm going to make this year? I'm going to make one great quality acquisition. What is that acquisition going to be? Fantastic. I'm then going to start to take a look at the following year. Where am I going to be in my overall loan to value on my portfolio? So that you're stretching this period out over a period of time versus taking on, let's say it is that buying period. Wonderful, fantastic. But it doesn't mean that you're going to be able to go out and pick up 2, 3, 4 properties and be like, portfolio, in 6 months kind of thing. It's going to be a slow and gradual build is really what they're working at here. And it makes a lot of sense in a lot of ways because that idea of if you acquire a property every year for 5 years and then upon renewal, you're looking at doing an equity takeout, you're going to be able to balance that amount of leverage in your portfolio. You're not going to be sitting up at, everything's at, 80% or 75% where they're uncomfortable, right? You're going to have the mortgage pay down happening. You're going to have these mechanics that are going to be in place. And it's going to make life easier for you as the investor because you're going to be able to sleep better at night. And it's going to make your borrowing power go a little bit further. So I would say big one right there is tortoise versus hare, I think is how to kind of summarize that.
And as an investor, my first instinct when I hear about these changes is, oh no, we're being screwed. But as you're going through this, it makes so much sense because we've seen this happen over the last 3 years since 2022, that with the mortgage interest gone up, so many people were in a situation where they over leveraged. Because they borrowed because money was free, money was just flowing, and these stress tests and all these limitations weren't there. It put them into a really difficult situation where where you're saying about, yeah, it's a buyer's market out there and people are selling. You can pick up something that less. The reason for that is because people over leveraged, because they didn't calculate correctly, because they didn't think about the interest rates going up. They were just basing it on those 1%, 2% interest rates that they had. We were double counting rental income. We were double counting income. We were double counting all these things that then didn't put them into a situation where they were strong financially. So when all these market things happen, we've seen so many people go bust and having to give up, having to change their dreams. All of these things happen because they scaled way too quickly.
Way too quickly. Not only have we seen, unfortunate stories on the investors side, but you can also see that defaults are up, specifically in BC and Ontario. Those are the two leading provinces here in Canada where you're seeing mortgage defaults that are up. Lenders are most lenders, right? There are predatory lenders out there. It's not who I work with and who I deal with, but some lenders at the end of the day, they can see, down the road to be able to say, okay, I know in 6 months the client's not going to be able to make the payments. We're going to take the property back. Okay, that's great if the market is in a booming cycle, but no lender wants to be stuck with the asset. They want to be able to execute the loan. That's what their job is. They don't want to be able to get into now we've got all these properties that we had to take back. And you can see in Ontario and BC, the defaults are up. As OFC's responsibility is to be able to really set these industry guidelines. It's part of this is just changing those mechanics, as I said, just tightening ever so slightly so that you're not going to be able to get yourself in that kind of situation anymore.
It's to protect us, the investors, so that we are thinking about things long term, that we are able to continue our portfolio, to manage our portfolios when things happen that's unforeseen.
100%, 100%, right? And I think it's kind of leads us to the next one, which is, who is most affected by these changes right here? So we've kind of got four camps that are really affected right here, which is, if you own multiple investment properties, if you've got that 3+ properties, you're going to face intense scrutiny. And this is not to mean that, you're not being responsible. It just means, make sure that you're running your books and your numbers as tightly as possible. They're going to look at what the qualifications are, what the values in the market are. Will the lender be checking in potentially on an annual basis to be able to see how things are going, your current job status, all those sorts of things. So it's not to say that you're going to have to requalify throughout the period of the loan, but they are going to be able to increase that scrutiny. And each lender is going to have its own requirements as to where they want to be able to do that and where they're most comfortable. The next one up is it's that total debt versus income. And again, in the residential space, this is the big factor right here, which is you've got that 4 to 4.5 times amount. It's like, great, I earned this. I can then qualify for this much in terms of borrowing, aka mortgages, depending on your credit, depending on different things and your employment status. But they're going to take a look at these limits that are implemented, and they're going to be able to look at more thresholds. So they want strong cash flow on the properties is really what investors need to be able to take a look at, which is, again, in the multifamily commercial space, they're looking at the asset. Can the asset sustain? You as the borrower in the residential space, can you pay the bills? But can the asset also sustain? So we're seeing a merging of kind of thoughts and mechanics coming together here.
Well, many times people go in and banks didn't care at the time with negative cash flow.
No.
Now it's not possible.
It's very, very difficult, right? And I mean,
Yes.
in that one, right, what would be a strategy to take a look at, just as kind of like taking it as an example? Maybe you look at if it's a property that is undervalued or it's underperforming, not undervalued, underperforming, and you know that you can go in and make those changes and increase the revenue from that particular property by whatever those mechanics that you're going to do. That's the time to be able to take a look at saying, okay, do I look with a private lender? And maybe it might be like a 1-year deal where you go for a private mortgage, you go for a private lender, it's a 1-year deal, you're paying interest only, and in that 12-month cycle, that's where you're putting in your work, your equity, your time, your energy to be able to go ahead and increase the revenues. And maybe it's adding another bedroom, maybe it's separating the units ever so slightly, whatever you're going to do. But then after that, then taking it back and going to a lender that will say, okay, great, now we want to put it into long-term financing or more normalized financing. So it's not to say that it can't be done, and I want that message to be really clear, which is there's always strategies to be able to get things done. But in this particular process, we just want to be heads up as to what's coming down the pipeline for us. So 2 points here to just conclude right here. So it's really, relying heavily on rental income to qualify. They're not going to look as much of that income as, they have in the past, right? Yes, you want it to be there. Make sure the numbers are tight. Make sure that the leases are strong. Make sure the information is all really good. But they're not just going to be able to say, okay, great, the property produces X, Y, and Z, and we'll just be able to float you a loan on it. They're going to get more stringent. And the last one is, and I touched upon this one, which is your plan to scale in the next 12 to 24 months. So this is really about strategy now. It's like, great, there could be a great deal out there, but don't get lost in the shiny object syndrome, which is like, oh, this deal just came across. know what your marks are, know exactly what you're looking for. And when that lines up in terms of your strategy, that's the property that you want to try and work on. That's the one that's like, now it's in the crosshairs. I'm going to go for the offer. I'm going to make my moves on it. But if a great opportunity comes up that is not within your strategy, let it go. Let it go. Or consider a different one. Maybe it's a flip or a burr or something that's, again, in a private space, but you're not looking at it for like buy, hold. It's going to produce rental revenue on a regular basis.
Right. And this is great. So I love this slide, and I think everybody should take a screenshot of it because it really summarizes those changes really well. So when people are going into now looking for their next property, they should be considering all these things if they're looking at uh, financing themselves. And like you said, it doesn't mean that they can't do it, but they have to look at it from a different strategy perspective. So you may find a wonderful deal, but it may not be one that you're self-financing. Maybe you need to look at it from a different perspective.
100%. So almost at the finish line here. So this is the good news, guys. I know it sounds like this whole interview has been a little bit like, oh, how are they, as you said, how are we getting screwed, right? Kind of thing. And it's not. It's more protection in there for a number of macro reasons. But, how are smart investors going to navigate these changes? And I think these are the points, right? Because as I said, there's always challenges, right? And it's just really about understanding what they are, how you're going to navigate them, and how you're going to prepare for them. So the first one is it's the lower loan to value ratios on new acquisitions. Be prepared to be able to pencil in when you're underwriting that property, when you're running your numbers. Look at 30 to 35% down, not 20% and going that route, right? The next one would be optimizing the cash flow and, yes, that service coverage ratio. So that's the DSCR, more in the multifamily space. But now they want to understand, which is that property going to be able to go ahead and cover the mortgage, property taxes, the utilities, the insurance? These are the core numbers that they're going to take a look at to be able to make sure that that property is going to work. Diversify your lender relationships, which again, I remember when I first started, it was such a light bulb moment where I remember listening to someone talking about like how many people have got their savings account with the bank, the RSPs with the bank. And I'm the guy raising the hand going, oh, we're with RBC. We're an RBC family. We got it all with RBC. Aren't we happy, kind of thing. Thinking that meant RBC was going to give me some sort of preferential treatment out there. Diversifying your lending relationships is such an important strategy out there, not only market choice, but also asset class wise. And if you can go ahead and do this, you're going to be more successful. So don't just go to one and go back to them. Don't just walk back into, your nearest branch and say, great, I found a property that I want to be able to buy. Give me another mortgage, kind of thing. Give it a little more thought than that. That's for sure. And the last one is stress testing your portfolio. So what happens in the event of costs go up? What happens in the event of, interest rates? Again, if you're on fixed, and I love the fixed model because that means that you know what that price is every single month. It's not going to change. But when it comes up for renewal, guess what? And a lot of people are experiencing that shock where, yeah, they purchased 5 years ago. I got my property at sub 2%, and now it's coming up for renewal. And either I can't renew it and it still is cash flow positive. And the thinking is now I go ahead and I sell it and I dump it. Well, if it didn't work for you at 4%, how's another buyer going to come in and make it work at 4%, right? So you have to think about that particular one. So these are the areas that investors can really start to take a look at and put into their strategy on the front end before they start going out and making offers and thinking about these 4 key points.
I like this portfolio part that you keep stressing and that's important. And it's again, I'm seeing the trend throughout these changes that you're bringing up. It's not this look at the one property perspective. It's look at the entire portfolio. And within your strategy, you need to be thinking that. Imagine if you acquired all 5 properties in the same year, and then you have to renew all those 5 properties again with changes with all these things. How are you going to qualify?
That's such a good way to put it, right? It's so much harder. And I know everyone wants it. We all want to be able to achieve those goals. Real estate is a vehicle, right? It's going to take you there, and you have to be able to respect the ride. Is really what I've learned as being a property learning investor now, is that you can change certain mechanics, but you're not going to shift the market. You're not going to change lending policies. You're not going to change government policies. You're not going to change the political environment. We can't do that. Yes, we can buy properties. We can do certain things. There's lots of things within our controls to be able to do on really the micro level. But when you're talking macro, right, those things are going to happen around you. And now you need to really be able to continue to be buoyant. You need to be able to continue to make sure that you're always afloat and you're not getting caught with, I took a chance, it was an aggressive play, they changed the policy, and now it's encumbered me in all these different ways.
Definitely. So stop looking at the very, like from a property perspective, and look across your portfolio.
Yep. Yeah. So I know we've taken up a lot of time here, and I do appreciate it. Right. I want to be able to come to the end right here. And what does this mean, and what does it not mean? So really, the misconceptions is that the Canadian real estate investing market is done. I don't agree with that whatsoever. It's not the case, right? Say this is the death of real estate investing. It's not the case out there. Rental financing is disappearing. No, not the case, right? Not the case. These are the changes that OFC wants to put in place. Lenders will start to be able to change and make changes to their policies, right, in terms of how they can work with investors that want to be able to own another property. And then investors can't grow portfolios anymore. Again, I don't believe it, but it's not going to happen in the way that it was 4 or 5 years ago, where it was like, great, I can acquire a number of properties. And I keep thinking about that one thing about that fearful when greedy. Do you know that line?
Yeah, greedy when everybody's fearful, fearful when everybody's being greedy.
Thank you very much. Yeah. So I think that line, unfortunately, has had its day, right? It's about being consistent now and being really strategic. So can you grow a portfolio? Yes, you can. Can you go ahead and get financing on rental properties? Yes, you can. It does mean, though, higher standards for qualification and documentation. So be heads up, be alert, be aware of that one. It means being better prepared, where investors gain competitive advantages. It also means strategic portfolio management, right? So we've talked so much about that, but that's really, it's about that, which is if you want to be able to get into owning rental properties, start thinking of this as a 15-year game, a 20-year game, instead of like, what am I going to accomplish in the first 5 years? And the last one is, obviously professional guidance creates meaningful value. So I would say, getting ahead of it now, and if your plans are in 2026, you want to be able to buy another income producing asset, then to be able to have a review with a mortgage agent or a broker that really understands these numbers, that has access to the right lenders and has the right mindset, that can start to be able to take a look into these items for you now and give you the right direction, so that when you're out there and you're the one that's in the market, you're making the right decisions and the right moves.
Awesome. I love this summary. This is so good. So we are running out of time. Ray is offering a free, no obligation discovery call and a mortgage review to all of our audience out there. So please do contact him. His details are on the screen, and we're also going to put it into the show notes. So reach out to Ray. Thank you so much, Ray, for all this great information. I think it was very important, and I'm happy that I was able to connect with you and we could get it out there, because we are coming to the end of 2025, and I know a lot of people are planning their goals, doing their goal setting right now, looking at 2026. And so these are things that you should start thinking about. How are you going to grow your portfolio now based on these new rules?
Of by no means am I trying to temper anyone's ambition, right? But take the right steps so you're prepared and that you know what's going on, right? The more knowledge we have, the more you can leverage that, the higher your chances of successes are out there. And I would say have a conversation. If it's with a broker, an agent, or if you're dealing directly with your bank, go ahead and have that conversation. Start it early now, so that when you're ready, you've got all your ducks in a row, right? It's not just, now we've locked up the property and it's like, let's do diligence. Now it's like the pre-diligence is kind of what we're talking about right here. So with that said, Debbie, I want to say thank you so much for the opportunity of coming on.
Thank you so much, Ray, for coming on to the Let's Talk Real Estate Investing podcast.